Would you have purchased the Reddit IPO the day it came out? Jedediah Collins here with the Money Vehicle Movement podcast, where we're trying to make financial literacy a little bit more current and even possibly a little cooler. The IPO, initial public offering. The how do you even start investing in one of these things? Well, in investing, we learn risk equals reward. This is a principle of investing we cover here at Money Vehicle in the Do, Re, Mi sequence. How do you learn to read? ABC. How do you learn to sing? Do, Re, Mi. How do you learn to invest? Oddly, Do, Re, Mi as well, where Re equals return being risk. In Chapter 6, we look at the riskiest investments, and IPOs have to come to mind. An IPO, or initial public offering, is the first time the public can purchase shares of what was formerly a private company. On the first day of trading, people get so excited they rush out to buy a share of this very unpredictable stock in the hopes that from the magic number the IPO was set to start at, is just the bottom and only upside is going to come next. For example, the IPO listed at 20, but it's going to be 40 by the end of the day and 400 by next year. Well, if we know anything about investing, nothing only goes up. In fact, the first days or even weeks after an IPO, the stock price will often fall below the original IPO price after the hype has kind of run out. The sequence goes ding, 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 the bell is open and the price is off and running for a few hours. And then the excitement kind of wanes. People who were chasing the up begin to see the down, and many of which are retail or average investors who will now be eating the losses as the stock falls from the first day high to 20 or 30% below even the original list price. Take social media platform Reddit. Its IPO is a great example when it started at $34 as the IPO, initial public offering. It went on a crazy run, skyrocketing up to almost $75 per share. Remember, these are retail investors, emotionally driven. The same group, Reddit, that really held up some of the meme stocks, well, they gathered together and they pushed the stock price to $75 per share. Many novice investors thought, we have to jump in before it goes to the moon, buying shares in the $70 range, only to see the stock fall 40% in the next few months. And all of these young, retail, emotional investors began holding the bags of these losses. These IPOs are the most uncertain because they have no track record, and most of the information about these companies have been kept private up until the point they decided that they wanted to go public and start to raise more revenue, or raise more dollars to grow the company. While there is excitement in an IPO and a great story for someone who can say, I bought Amazon on the day it IPO'd, there is a reason Money Vehicle preaches the B average index philosophy. Experts are trying to predict where these stocks will go without very good accuracy. And we're not just trying to churn a profit on day 3 of the IPO, but year 3 or even year 13. When you chase an IPO, you take on great risk of losing money. And that is something here at Money Vehicle we are trying to avoid, while also understanding some risk is needed for that return. The B average mindset may lose some here and there as well, but it will not have the cliffs that chasing an IPO does. Won't have the upside either. That is the trade off. You can show people you speak money by being average, taking the average of what the market will give you, not chasing the emotional driven pieces of things like an IPO. Take what the market will give you until you are confident and you can take on more risk. The beginning of your plan, you need risk, but you don't need excessive risk. You don't need to hit a home run right out of the gate. Just get on base first. Keep driving your money vehicle, and we will see you at the next stop.